Hello, this is Tony Welch, Chief Investment Officer at Signature FD. Thanks for joining me for our special 2026 Outlook iteration of our investment webcast that we call Cutting Through the Noise. So let's start with a look back at 2025. So this table here shows returns over the last 5 years and also each of the quarters in 2025. One thing that was evident last year was less about an economic breakdown and more about policy driven volatility. We had moments where headlines moved faster than the fundamentals, with the most notable being the Liberation Day tariff announcement shock back in April. Now, what mattered is that volatility ultimately normalized and market leadership broadened. No single asset class led the entire year. International markets had their strongest outperformance since 1993, and it was certainly a year where diversification paid off. One major takeaway is that shocks do happen, but if they don't negatively alter the trajectory for corporate fundamentals, they tend to resolve to the upside. Now, moving to the outlook portion, we have three major themes for the year ahead. Our first theme is the K-shaped economy. Different parts of the economy have moved in different directions. Higher income households and larger companies have generally been holding up better, while more rate and inflation sensitive areas like smaller companies and the lower income cohort have felt pressure. The question for 2026 is whether that gap can begin to narrow, and we think there's a good chance that it can. So this chart here gets at an important point. Consumer confidence is already very low, basically rock bottom levels. When sentiment is depressed, it often doesn't take great news to improve. It just takes news that's less bad. If the consumer gets even modest relief, that can be a positive for economic growth in 2026. Now, one potential source of relief is tax refunds. That may sound mundane, but for many households, that's real cash flow, and it can support spending, especially for the more constrained parts of the economy. Last year's tax legislation should start to manifest itself this year as tax refunds are projected to be over $150 billion higher than they were in 2025. That should be a source of consumer sentiment or stimulus. Now, the Fed is another key swing factor. The direction matters. We believe that the bias is going to be towards easing this year rather than tightening. Rate cuts don't instantly change the economy, but they can gradually improve financial conditions. And that can help broaden participation beyond the biggest companies and highest income households. Now, trade policy is still an important backdrop, but one encouraging idea here is that we may be past the worst of the tariff-driven inflation impulse. Even if tariffs remain high, stability matters. Fewer surprises make it easier for businesses and consumers to plan. Here in this chart, we're showing different components of inflation, and the solid blue line is core goods. That's the area that has been most impacted by tariffs. You can see that it rose last year, but the last few readings have eased off of that peak. Now, housing is a big deal because it touches everything: budgets, confidence, mobility. If affordability is improving at the margin, that's another way that pressure could ease over time, even if it doesn't feel easy yet. This index here in blue in this chart measures housing affordability, and it looks to have bottomed, and that implies that affordability is improving. A rising line in this calculation is a positive factor. Now, small businesses have been on the wrong side of higher rates and tighter credit here. If confidence is starting to bounce, it's a sign that the K-shape might be narrowing. Maybe not overnight, but at least gradually. And remember that small business is the largest employer in the United States, so a pickup in confidence has downstream implications economy-wide. So while there's plenty that could go wrong, there are some important factors that could help narrow that K-shaped divide here in 2026. Now, theme 2 is around artificial intelligence, and specifically a possible shift from AI enablers to AI users. The early winners were the infrastructure and platform providers. The next leg could be companies using AI to lift productivity and margins. Now, this chart highlights how valuations have really separated. The biggest companies are priced very differently than the rest of the market. That can persist for a while, but it also sets the stage for a wider opportunity set if the market actually begins to broaden out this year. Now, here we're watching something subtle but important. The gap between both share prices and corporate fundamentals between the big Magnificent Seven names and everything else did begin to narrow in 2025. Earnings are expected to converge further in 2026, so the superior fundamentals that the mega cap names have shown in recent years is closing. And that implies we may want to take a closer look at the rest of the market this year. Now, this is a big point here. The market is getting more discerning. Instead of everything AI goes up, investors are focusing on who can monetize and who can't. That's healthy and it favors discipline. So we can see that in 2023, all 7 of these companies handily beat the S&P 500 index itself. In 2024, 6 of them did, but in 2025, only 2 of them beat the market. We expect this trend to continue where the big AI names aren't universally bid up. Expect more dispersion. Now, we're not negative here on the AI enablers, as AI investment is real, but it's also expensive. Many hyperscalers are accelerating CapEx or corporate investment, which can pressure free cash flow in the near term. The long-term question is whether returns justify the build-out. For some of these, it may, and others maybe not. Again, this points to a market of winners and losers, not one big AI trade. And for a PSA, this is a reminder not to anchor to yesterday's winners. Markets rotate, and long stretches of dominance are often followed by periods where different areas lead. This chart shows the top 10 companies in each decade starting in 1985. Note how the names change, and not a single one of the biggest companies from back in 85 is one of the 10 largest today. In fact, only one name from 2005 is still in the top 10 today. The next decade will likely be defined by a different theme. Now, this is where the user's angle comes in. If AI adoption spreads, the beneficiaries may increasingly be companies improving efficiency, not just the companies selling the picks and shovels. This chart shows AI adoption by sector. It's relatively low, in my opinion at least, so many of these companies have an opportunity to pick up efficiency with higher AI adoption. And this supports the same idea. The rest of the market has seen improving fundamentals. So this table here breaks out the different styles in the market, and it shows that large cap growth, where many of the AI enablers sit, actually has seen a sizable contraction in sales and also in their profit margins. We suspect that the AI game is going to be cutthroat going forward. But look at the potential beneficiaries in value and small caps. Sales have improved, and so have profit margins. Now, theme 3 is around policy, fiscal, Fed, trade, and geopolitics. Policy is supportive, but less predictable, and that tends to create dispersion. Different winners and losers rather than just one clean market narrative. Our base case is that policy remains broadly supportive of growth in 2026. That doesn't remove volatility, but it can keep the economic floor in place. This chart combines Fed policy, fiscal policy, and the direction of the US dollar. Policy is pretty neutral right now, but with more rate cuts probable and the fiscal spend picking up, we think this could move into a more bullish zone for the economy as 2026 progresses. Now, the trade-off is sustainability. Supportive fiscal policy can come with longer-term budget consequences. Markets can live with that for a while, but it's part of why we expect a wider range of outcomes. Here, we're showing the original CBO deficit projection before last year's tax legislation in the solid blue line. The dashed line shows scenarios after the legislation passed. The deficit is likely to increase. Now, we don't worry so much about that today. A widening deficit has tended to actually be market positive, But eventually, if legislators decide that austerity is the right path, that could result in sluggish growth in the future. Now, inflation is down from the peak, but it's not fully slayed. At the same time, the labor market is showing some softening, and that matters more for the Fed's path and for consumers than inflation right now. So the Fed is more focused on that labor side of their mandate. But if inflation accelerates, which isn't our base case, but certainly possible, they may have to pull back some of this easing campaign. Now, tariffs remain elevated. That's the structural backdrop. So we don't assume a frictionless global environment. But it is important to note that tariffs are not nearly as high economy wide given important exemptions. The blue bars here show the tariff rates on all dutiable imports, and the orange bars show the tariff rates on the totality of imports. So it's meaningfully different across most regions with the exception of China. But importantly, uncertainty has eased at the margin. Fewer shocks and therefore more business planning is possible as trade uncertainty eases. That can reduce headline-driven volatility, even if tariffs stay where they are right now. This is a longer cycle point. Inequality tends to fuel populism. That can influence taxes, regulation, and trade, and it's another reason dispersion can remain high. Here we're showing the Gini coefficient for various countries, and the US scores the highest, which means we have the most inequality. This is a good chart to explain the populist movement. Now, geopolitics is less about one big predictable event and more about ongoing pressure on supply chains, energy, and defense priorities. It's a persistent variable that we respect, and we diversify accordingly, but often results in shocks, not true changes to fundamentals. This chart shows that the betting odds of a U.S. strike on Iran are rising. This is one example of higher geopolitical tension, and we expect that geopolitics is going to be a market narrative all year, as it typically is. Now, this is one of the most useful filters we have. When a headline hits, we ask, does this change earnings, cash flows, or the cost of capital, or is it mostly noise? That mindset helps avoid emotional decision making. Note that the S&P 500 has risen almost in lockstep with corporate earnings all the way back to 1900. As long-term investors, we view headlines through the lens of, does this negatively or positively impact corporate fundamentals? Now, one of our key investment themes is that 2026 may reward flexibility, not because we're trying to trade every move, but because leadership can rotate and opportunities can open up in less obvious places. Dispersion is a key takeaway. Rising dispersion means returns vary more across companies, sectors, and regions. In that environment, diversification helps, and so does being selective in certain segments. Here in this chart, we're showing that the difference between expensive and cheap stocks is typically about 15 times in their respective price-to-earnings ratios. Today, it's closer to 19 times. So some stocks are more expensive than they typically are, and some are cheaper than they typically are. This is where active management may be able to add value, especially in areas where security selection and risk management matter the most. Passive investment is still useful, but in a more dispersed world, active can be a meaningful complement. Asset classes in the alternative space have seen top performing managers meaningfully outperform lower performers. But in US large cap stocks, the divide is quite narrow. And even though the spread is tight in fixed income, we do like to take a little more of an active approach in fixed income as well. A practical takeaway, portfolios drift. After strong runs in certain areas, it's easy to become unintentionally concentrated. Staying balanced is often less about prediction and more about maintenance. This chart shows that a 60-40 mix of stocks and bonds at year-end 2019 would be 72% stocks today if you didn't rebalance. That may be fine if it fits your financial design, but many investors may be well suited to rebalance back to get a more diversified, forward-looking portfolio. If the economy broadens and financial conditions ease, smaller companies could benefit more than they have in recent years. We're not forcing it, but we're watching for the setup for small caps to improve. That would fit with several of our themes for the year. Note that small caps are much less growth weighted than our large caps. Now, international markets remain relatively undervalued versus the US by historical standards. If global growth broadens and the dollar backdrop is less supportive for US only leadership, international can continue to play a meaningful role in portfolios. This chart shows that even when we account for a larger growth stock allocation in sectors like technology within the US, the international markets still look relatively attractively valued, with every individual sector cheaper internationally than they've typically been in comparison to the US. So to wrap up, 2025 was a year of policy shocks, but leadership broadened and volatility normalized. Looking into 2026, we see three big forces: a potential narrowing K shape, a maturing AI cycle that may broaden beyond enablers, and policy as a driver of dispersion. Our approach is steady: stay diversified, stay disciplined, and remain flexible as leadership evolves. Thanks for joining us, and we wish you a terrific 2026 ahead.